Good morning, everyone. We're going to start in a moment, but first I'd like to make a few announcements. There is an overflow room that we're opening up. There are also some seats scattered around, so if people standing in the back would prefer to come and sit in this room, you may, or in the overflow room just to the side. You can go out to the front hall and into the overflow room, and there are TVs and everything set up. In addition, we know it's hot, and we've asked the facilities manager to up the AC, and I think that's happening. So I appreciate your patience. Please bear with us. It will cool off in a moment or two. Wendy? Okay, so I'm going to ask Wendy Garcia, our Chief Diversity Officer, to come up and kick off the program.
Good morning. Good morning. I can't hear you. Say it again. Good morning. All right. Welcome to the Comptroller's Annual Investment Manager Conference. My name is Wendy Garcia, and I'm the Comptroller's Chief Diversity Officer. My position, which was created by Comptroller Stringer when he first came to office, is tasked with being the watchdog on diversity across city government. Our focus is ensuring that the city uses its financial power from contracts to investments to give diverse businesses a fair shot. From working on corporate governance team on boardroom diversity, which has led 17 companies, and you can clap for this, to add diverse directors, that's the applause, to implementing policies that boost diversity in the investment world, like our emerging manager graduation process, to digging through city data and grading every agency on their contracting with MWBEs, which has highlighted how just 4.8% of the city's procurement budget went to these firms. Our team is working every single day to make a real difference. But we don't just talk about diversity. We don't just lecture others. Comptroller Stringer has made it a cornerstone in our office. Just look at our own board of directors, our own leadership team. 8 out of the 13 deputies, more than half are women, and many of them are here today. So shout out to Elena that's out in the front, Sasha Owen, leading our office every day. So let me tell you, if we can do it in government, companies can definitely do it on Wall Street. But these policies aren't just advancing diversity for diversity's sake. Studies have shown that incorporating different perspectives leads to better returns, and that means that by championing diversity, we're helping grow our portfolio. Listening to diverse voices is part of how Comptroller Stringer has grown our pension funds from $148 billion to $175 billion. And we did that because of you in the room and all your hard work since 2013. So without further ado, please help me welcome our gracious host, Mel Arison, Treasurer of the United Federation of Teachers.
Welcome to Albert Shanker Hall. Albert Shanker was the president of the UFT for many years and was probably the most important voice in public education in the nation during his lifetime. And so this floor is dedicated to him, and many of you have been looking around. Some of you are familiar with Al's work, and the rest of you, please take a look at it. We're very happy that Comptroller Stringer has asked the UFT to host this occasion. We are at the UFT very, very interested in making sure that the money, I think about $75 billion out of the $170 billion, is money which is put aside for teacher pensions. And we want to make sure that that money is well invested and it is invested by a diverse group of money managers. Our controller, Mr. Scott Stringer, has seen to that diversity. He has seen to developing an investment staff that is probably the finest investment staff in public employee pensions in the nation. And I want to thank the controller and his staff for that. I would now like to introduce Controller Scott Stringer. Really needs no introduction. He has been our controller for the last 3 years and has done a sensational job in all the areas he has tackled. Scott Stringer.
When you get a compliment from Mel Aronson, it's like the stamp of approval. I can actually go home now and leave you to the conference. But can we give Mel Aronson a big round of applause? He really has guided so many of us in this space, in this field, and I just want to thank Mel because he has truly been a great friend and advisor, and I've learned just never disagree with Mel, and you will do well. I also want to thank a vibrant, smart woman in our office who has done amazing work, not just in New York City, but around the country on issues of diversity. She is a pace setter, and that is Wendy Garcia. I want to give Wendy a big round of applause. And I want to thank all the trustees of the New York City retirement system. The ones that are here today, I just want to give a special shout out, and that is Deborah Penny from the UFT, Tom Brown, UFT, Dave Kazansky, UFT, Pat Strikers from Teamsters, and Larry Schimmel from Nicers. Give them a big round of applause. And I want to thank the UFT and Mike Mulgrew from hosting this conference again this year. They also fight every day to strengthen our city's public schools, and I think that really matters, and I'm really proud to be at Al Shanker Hall. And I'd also like to thank the staff of the Bureau of Asset Management for their constant attention to the best interests of our retirees. Give them a big round of applause. Now that Mel Aronson has said they do a good job, they don't need me to compliment them anymore. But I do want to thank them for the work that they do year in and year out. This is a big pension system, and they do a great job. And I want to mention I think all of our trustees are great, but there's a special trustee who happens to be the executive director for pensions, and she truly does an amazing job for this city and for our retirees, and that's Susanna Vickers. I want to give... And I don't want you to think this is a controller love fest or we're trying to take credit in an election year, but the smart... That wasn't a joke. But the smartest decision I ever made as controller, and we've made some really smart moves, but the best decision we made was having Scott Evans as our deputy controller for asset management and the chief investment officer. Like me, he's a long-suffering Jet fan, but our pension system is better than that. So, look, many of you joined us last fall and have attended this year's conferences in the past. We're now in our fourth year in the Controller's office, and it does feel like time has flown by. Looking back on this term, we do take great pride in the progress we've made together to grow and strengthen our pension funds. It's many of you who actually move the money. You're in the room today. But I want you to know that the Bureau of Asset Management, in partnership with our amazing trustees, has brought this work to a whole new level. As you know, we started on day one by hiring our office's first ever Chief Risk Officer, Chief Compliance Officer, and Chief of Internal Auditing. We work with our trustees to enact a long overdue ban on placement agents. We took on management fees at our funds and across the country, and we got to work on bringing all 5 pension boards together for one common investment meeting to save time and resources. That was never done before, and that hard work is already paying dividends. But we also decided right from the start that we had a real opportunity to put our value system into action by focusing on diversity. Because investing in diversity is not just the right thing to do, it's actually the fiscally responsible thing to do. And as a fiduciary of our city's pension funds, maintaining fiscal responsibility is ultimately our top priority. Our first step was hiring this office's first ever chief diversity officer. And then we got to work using the tools at our disposal to change the way the New York City pension funds do business. We launched the Boardroom Accountability Project, our national campaign for proxy access, to allow large long-term shareholders like our pension funds to nominate independent board of directors using the company's ballot. And we've had some tremendous success. When we started, only 6 U.S. companies had proxy access bylaws. Today, less than 3 years later, it's more than 400 companies, including 58% of the S&P 500. And we've had 17 directors from diverse backgrounds appointed to boards at companies that we targeted for lack of diversity. Now, that's a real, measurable impact our work is having on corporate America. I want to just take a minute to mention the campaign we launched this week to reform the Board of Mylan, which reached new lows in 2016. In the midst of the EpiPen price hiking controversy, which caused significant harm to the company, the board approved $97 million in pay to its chairman. $97 million. Now, in partnership with New York State, CalSTRS, and PGGM, we are urging Mylan share owners to vote against the 6 directors most responsible for the company's costly oversight failures and against executive pay at the company's annual meeting. If you hold Mylan in your portfolio, we're asking you today for your support. Please make sure the relevant decision makers read our letter. It's available on the website and also on the SEC's website. If you think about an EpiPen, you have to think about your children, the children who are your friends and family, and most importantly, the kids you're never going to know. We need reform at this company. I also want to focus on our work with all of you as it relates to our investing. Maintaining our focus on diversity within that space could not be more critical for our pension funds and our city economy, because again, our diversity drives value. Now, according to a McKinsey analysis, for every 10% increase in racial and ethnic diversity among a company's senior leadership, pre-tax earnings rise 0.8%. Diversity is good for business. It's good for our city. And when we add opportunities for women and people of color to invest our pension dollars, that creates a pipeline for the next generation. It builds aspiration for the students in our public schools and our local colleges. We make the kids understand that if you work hard, you play by the rules, you study hard, you'll get a good job in finance. And it improves access to capital for all of our communities. It tells our young people that no matter what you look like, no matter where you come from, we want the best and the brightest working with the New York City pension funds. And today, our MWBE managers are key to the success of our pension funds. That's why we've continued our commitment to growing our investments with them. Hear this. Today, about 7% of all of our assets are allocated to MWBE managers. That's about $12 billion. That's up 25% since 2013. I'm going to say that one more time. Think about this, okay? I want everybody to wake up now, because this is a big announcement. $12 billion, up 25% since 2013. That's good for everybody, right? That's good. And as you know, we now ask every manager who wants to work with us about the diversity of their leadership and investment team. We are the first public pension system to incorporate this specific criteria because it truly matters. A diverse team makes better decisions, and diversity drives value. And I want to talk for a second about our priorities for this coming year. As I mentioned, we have increased our overall allocation to MWB managers, and we've seen significant growth in certain asset classes. In private equity, our investment with MWB managers has grown from 14% to 20% since 2013. We were at 0% in opportunistic fixed income when I started, and we've now grown that to 6% women and minority-owned businesses. And despite the fact that 97% of hedge funds are run by white men, we went from no MWBEs to 13% in our hedge fund portfolio. Now, we're not stopping here. We're focusing in on MWBE growth in classes where numbers are low, specifically alternative credit and private real estate. Now, beyond our work to support MWBE managers, we've introduced new diversity initiatives to reach our goals. Graduation is a critical strategy to growing MWBE managers, and funds of funds are simply not enough. MWBE managers under funds of funds have limited assets and do not have a direct relationship with the pension funds. Now, we have improved our graduation policy to make it easier and faster to graduate successful managers. But second, we've established the Bureau of Asset Management Advisory Working Group on Diversity to advise our CIO and investment staff on how to improve and sustain the diversity initiatives we're talking about today. This is the first time in history that BAM will have an internal group focused on strengthening our institutional commitment to diversity. That means the door is even more open than it's ever been, because we are going to be working on this internally day in and day out. And we want to hear from you, and we want you to hear from us, and we want to continue the respect that we have built over the last 3 years, because only by us all working together and learning from each other can this prove to be successful, because at the end of the day, this is about growing returns for our retirees and our public pension system. We also are going to increase outreach to investment managers so that we have the ability to encourage greater use of MWBE brokers consistent with best execution. We set goals for investment managers and public equity to use MWBE brokers for 20 to 25% of their trades, and we're working every day with our managers to reach that goal. So BAM has been busy, and so have our pension boards. In December, the 5 boards approved an investment consultant to develop a policy and process for addressing the risks of climate change to our portfolio. And they voted to conduct the fund's first ever carbon footprint analysis to truly understand the impact of our portfolio companies on the environment. Later on today, I'll be briefing President Trump on the no, just kidding. You actually thought, some of you. Wow. Susanna, good work. Look, for our pensions, our pension funds, our staff, our managers, and most importantly, for the 700,000 New Yorkers who rely on all of us together to protect our retirement security, we have made important progress, and I know we're only getting started. And I want to really thank everyone in this room for your sound partnership. I look forward to another year of working together. I look forward to us building bridges and working for the people who built our city, those police officers, firefighters, school teachers, the city workers, the people who worked a lifetime building what an amazing place we call New York. And our responsibility is to make sure that they and their family have the retirement security that they have come to rely on. This is very, very important work, and this is the work we do with all of you. So some of these new initiatives are about broadening our reach, creating opportunity economically for everybody, but it really does matter. And the reason we have this conference today is so you can hear from our CIO and all the people who work with us to build that bridge and those relationships. And I'm very proud to be here today and to serve as controller. Now, I'd like to shift gears because we are now going to present the second annual Controllers Diverse Practitioner Awards. These have become the Academy Awards of pension, right? Right? This is what you. That's why you're here this morning, right? Many have been nominated, but only 2 will be picked. And we began this tradition last year to recognize investment managers that have demonstrated a strong commitment to diversity in their investment teams, their executive leadership, and in their policies. You should note this award doesn't come with any money or expectation of allocation. Now, this is the serious stuff I have to say, you know. But This is the part of the meeting where we do celebrate achievements by a few managers in an area that is important to the future of our pension funds. And as I mentioned before, we ask all managers about the diversity of their investment professionals and how they ensure a culture that embraces diversity. We present this award to recognize managers that have demonstrated strength in this area to the benefit of our funds and to inspire others in the industry toward collective progress. So, drum roll. Ladies and gentlemen, first up for our public markets managers goes to Neuberger Berman. As one of our public fixed income managers, Neuberger Berman has grown a commitment to ensuring diverse candidate slates, promoting internal mobility, hiring and supporting diverse interns using qualitative assessments of diversity and inclusion efforts. They continue to improve their policies. So let's welcome to the stage Andy Johnson, the Managing Director and Head of Global Investment, Grade Fixed Income. Come on. Some of you may be here someday. Patricia Miller-Zolar, the Managing Director. Come on. And Carter Reynolds, Managing Director, to accept this award. Carter? No. I want each of you to touch it. Do you want to say something? Just one. No, first we speak, then we take pictures. I'll tell you what to do.
I'm going to be really brief. I've got two feelings right now. One is shocked, the other is humbled. Shocked because I never expected to get an Academy Award, actually. Probably because I've never been in a movie. But, I'm not one on details. But two, seriously humbled because we've been working with the city for about 25 years at our firm through many, many ups and downs. We think we've delivered, but diversity has always been important to us. It is at the firm. I have been having discussions with our CEO, these two may not know it, about diversity, oftentimes unsolicited, right? But now, oftentimes he's coming to me. And the reason why I bring that up is because diversity only works if it's from the top down and bottom up. And at our firm, I can truly say, and I wouldn't say this if it wasn't true, but I didn't believe it, that we've got it working from the top down, and now we've got to get the bottom up working as well. As a leader of an investment team, I can tell you that circa 2017, the most important thing to get right is the team dynamic. I work really hard at that. And for me, a diverse team absolutely does lead to better results. I'm proof standing here that is in fact what occurs. And so I can tell you, those of you who are fellow travelers or not, it is absolutely true that diversity does lead to better returns, as the controller has talked about. So I'll leave it with that, and thank you very much.
Thank you very much. Congratulations. Thank you very much. Thank you. Thank you. Thank you very much. You take this. Thank you, everybody. Thank you. Give a round of applause. Thank you. Okay. So next, for private markets managers, I'm pleased to recognize Vista Equity Partners. Vista is so successful because of their deep institutional commitment to diversity in all aspects of their work. On top of promoting diversity in their organizations, Vista focuses on identifying diverse leadership for their portfolio companies. We commend this policy, which drives even greater value into their investment process. And to show you just how committed we are to an Academy Award-like atmosphere, we are employing technology to accept awards because we recognize that this is partly showpersonship. So, Robert Smith, the founder, chair, and CEO of Vista, Well, he can't be here today. But it's okay because he has recorded, like Hillary Clinton and others, a video that we're going to share with you now. Please welcome Robert Smith via satellite. He only found out about this 10 minutes ago. He was. We'll get there. Sasha, you have to believe. So the other part of the speech I have, it's only going to be another 20 minutes. I wanted to, no? Huh? All right. We're going to play this once we get the live feed from California. At some point today, we'll call you all back in the evening. But actually, the truth is, we never really wanted to hear from Robert. What we really wanted to do, we really wanted to hear from Christine Pistori of Vista to accept the award. She really wanted to come and make a speech. So, Christine, come on up. Here we go.
Gee, I didn't prepare a speech. I wasn't allowed to speak as an IR person, but what I can say is I'm truly proud to work for Robert and for Vista. He's a very inspirational person. He leads the firm, and the culture that he sets, it absolutely is advocating for diversity since the very beginning. And thank you, New York City, for being long-term investors since the very beginning of our firm and our first institutional fund in 2007. We really appreciate all your support, and we'll continue to build a diverse practice firm over the years.
Thank you. Thank you. No, it's okay. It's you know, I'm thrown with Robert, but it's okay. Let's give a big round of applause to
Thank you.
Christine and Robert. I'm introducing you. And now, ladies and gentlemen, I have a real honor to introduce somebody who, for the last 3.5 years, has guided the New York City retirement system, the CIO of our the New York City retirement system. I just want to say something about Scott Evans because I think it's important for people to realize this is somebody who thinks about our portfolio and our retirees day in and day out. It is a tough job because it's not just about his ideas and his investment strategy, which has got us to a very good point, but it's his ability to manage the hopes and expectations of our trustees, to make sure that we continue to stay on solid economic ground. Sometimes there are world events that even he can't foresee, but even times when we've had to make strong decisions, he has been a leader of an incredible group of individuals at the Bureau of Asset Management. Everyone, whether you're an investor or a retiree, should have the highest level of respect and the highest level of confidence that he goes to work every day making the strong, right decisions we need to grow our New York City economy, protect our retirees, and work with all of you. It is always a great honor and privilege to introduce someone I have tremendous, tremendous respect for, and that is the Chief Investment Officer for New York City. Please give a big, warm welcome to Scott Evans.
Appreciate it. Thanks very much. I have a couple of hours of prepared remarks, and then we'll get to questions. You know, I had heard when I came to New York City that we had this manager in our lineup in the emerging manager space that was kind of the Bob Dylan of emerging managers. But I think Robert's taken it a bit far by this performance. I don't know. It is remarkable, though. The awards that we just started last year are the real deal. It's not just a kind of a publicity stunt for us to show our most successful managers, and those were two of our most successful managers. But we have a rigorous process whereby we look at the diversity by number of people in the firm's investment management ranks across the firm. You know, what's the proportion of people in the various EEO categories. Importantly, we look at the board, the composition of the board, we look at the practices, and importantly, we look at the compensation and the breakdown of compensation amongst the various investment professionals. We don't ask for specific information on specific people, but we ask about compensation because that's where the rubber meets the road in the asset management business. And the firms that get our awards have passed a test where they're among the leaders in the industry. And it's a relative score. And we want to show people who are walking the talk. And I've had a couple of nominees express surprise to me that they would be nominated for a diversity award because the industry is not yet very diverse. But these folks are leading the pack, and we want to recognize them for walking the talk. Even Robert Smith. So, anyhow, Robert's terrific and one of our favorites. Now, we're going to talk about numbers. I'm going to go through some of the things that Scott looked at a high level. You know, this isn't what I'm supposed to say, but I'm going to do it. You know, elected officials get up here, and they take credit for stuff, right? Particularly in election years. They take credit for stuff that's happening. That's kind of, they're in constant motion doing that. And you get the sense when you don't work with elected officials every day that that's kind of what they do. That they're not, when times are tough, when you have to roll up your sleeves, when you have to do unpleasant things, you know, they're off at some picnic somewhere. That was my impression of elected officials when I reluctantly came to this office. And I met Scott Stringer. But I got to tell you, and this is something you can't see, and I'm not supposed to talk about, so this may be my last presentation to you. But Scott ticked off a number of things that we've accomplished, that he's accomplished, and that we've accomplished together. None of those things happened easily. None of them happened without pain. None of them happened without people with authority, and Scott Stringer in particular, rolling up his sleeves, working behind the scenes, making tough decisions, doing things that elected officials are supposed to not want to do to make forward progress and to build reform. So I really want to take a moment to thank him for underwriting all of our success, not only in front of the cameras, but back in his office on the days when we're doing tough stuff. So thank you. Thanks, Pat. So we're always looking for what should we do at this meeting. I view it as a partners meeting. This is one of the few systems in the country, and certainly the largest system in the country, that relies totally on outside managers. So if we're going to perform, if we are going to meet our return objectives, if we're going to provide retirement incomes for the 715,000 city workers who participate in our plan, we depend on you, our external managers. You run the whole portfolio. And so I think it's appropriate that we stop now. We've applauded ourselves and the folks that we work with. But you guys are delivering for us. You've been doing that for many, many years. And so I would like all of our existing managers that are in the room that are managing money for us today to stand up, and we'd like to give you some applause. It is an awesome group of investors. What we do in the Bureau of Asset Management, we try to do two things well. We try to identify outstanding investors, and we try to give them money at a time that's not a bad time. And that's a tough thing to do. All of the pull of this business and the pull of group dynamics is to be pro-cyclical, to give money to people at just the wrong time, just when they've gotten their Morningstar rankings, just when they've hit the top of the league tables and everyone else is trying to crowd in. That's the wrong time to give you money as good as you are. And so we're going to talk a little bit about how we try to do that, how we try to get to know you better, how we try to discover and understand your process to work with you over time to be long-term investors. So some of you are new to the city, and so I'm going to give a quick overview of who we are and what we do. Then we're going to have a couple of panels where we can talk in more depth about how we go about the process of doing those two things, identifying outstanding managers, giving them money at the right time, and having a very long time frame and a long partnership. So just simply, we have 5 systems that represent 100% of the folks who work in New York City. We provide basic defined benefit pensions to them. Our largest system is the teachers system that Mel Aronson has been involved with for 50 years. Close behind that is the NYCERS, the Employees Retirement System. And we also have police and fire and the Board of Education, which is everybody at the schools that's not a teacher. And that makes up the totality of our now almost $180 billion, $179 billion at last count. Scott talked a lot about emerging managers and how they're part of the makeup. And so I want to give you a little lens into that. And first to say that of the $179 billion, you heard Scott say $12.3 billion, or almost 7%, is with minority and women-owned enterprises. That money mostly comes out of the active portion of the portfolio. The active portion is about 2/3 of the portfolio, and that's the place that we have the greatest opportunity to find minority and women-owned enterprises. And so when we look at how we're doing on MWBEs, we look at the MWBE count as a percentage of total assets. You can see at the right that the $12.3 billion is 10.3% of our active managed assets. We believe that's among the highest percentage in the country for one of the largest funds in the country. We're the 4th largest fund, and I think we're the largest manager of external assets, or we're the external managers. We're not ready to rest on our laurels, though. You got to look inside that 10.3% and see how it breaks down. So we got $120 billion of active management money. 10.3 is MWBE. We're doing well in private equity. We talk a lot about private equity. Scott mentioned the 20%. In active public equity, we're 15% of the total. That's huge. That's really, really high. We've recently done some restructuring there. I'll talk about that in a minute. The other thing that we've done is hedge funds. Scott mentioned how we're doing there. I've been shocked at our success in the hedge fund space because there are so few hedge fund managers that are not white males. We've been able to find them, and it's happened fairly organically without our needing to put together any specific program. The place that we're really focused on, where we're not delivering at the level that we think is possible, is in core fixed income, private real estate, alternative credit, and infrastructure. Those are the 4 pieces where we're under 10%, and that's the focus of top management in terms of, how can we create an environment where we can do better in those asset classes. So when we look at diversity, and you know how important diversity is to us, and it's because our exclusive focus is providing risk-adjusted returns to our participants. And we believe very strongly that diverse practitioners make sounder decisions, and have a better chance of delivering value over time. So the focus in the MWB space is in alternative credit, which includes opportunistic fixed income, hedge funds, and bank loans, and also in private real estate, both opportunistic or riskier private real estate and core real estate. Those are the areas that we have circled that we think we have the highest chances of moving the needle in the next couple of years. It's not that we're not working on all of them, we are, but we're particularly focused on loosening up those areas, working hard with our consultants, all of whom are on the job, looking for managers particularly hard in that area. We're doing a procurement right now in the high yield space, and so that's where our incremental focus is. But we think that we need to continue to work the program across all spectrums. We mentioned that we want to recognize folks that are successful at walking the talk, and we just did that with Neuberger Berman and Vista today. But we also have to be more aggressive when we're investing with minority and women-owned enterprises to give them real mandates. So when we work with the fund-of-fund managers who are an extension of our staff in private equities, we don't want them to just dole out, $10 million to each minority manager and just sit there. And the minority manager has the opportunity to do $10 million with us. It's a nice little piece of business, but a real relationship with New York City starts at $100 million. And so if we have just these starter relationships with minority and women-owned enterprises, we're not taking full advantage of the opportunity to work with diverse managers around the country. And so we've wanted to find a way to graduate those managers, develop a direct relationship with them, have them get to know our consultants better. And so we have a structure now. We've recently restructured our whole emerging managers program in the equity space to accommodate that. In fact, we're incenting our fund-of-funds managers to help us find and graduate managers. When we graduate a manager, they get a bonus if that manager outperforms on the 3 years after they leave the fund-of-funds program, so that the incentives are completely aligned. And the fund-of-funds manager is incented to find us people that outperform the index. They're on a performance fee. Now I'm going to get into what we ask of you and a little bit of what you've asked of us. So one of the things we ask of you is to share the philosophy of investing in diverse managers when you go to find partners in the brokerage community to transact the trades on behalf of New York City. It goes without saying, but I'll say it anyways, best execution comes first. We don't want any trading to take place that's not best execution. That's the law. That's in the best interests of our beneficiaries, and all of us as fiduciaries have to do best execution. But it is possible to find minority and women-owned brokers that can execute best execution in all of these asset classes. And these are our goals. U.S. equities, 25%, non-U.S. equities, 20%, government bonds, 30%, mortgage-backed securities, 10%, and investment grade, 15%. And the bulk of our managers are hitting these goals and then some. And what tends to happen is that people don't have relationships, and so they're at very low levels, almost zero. And they just really struggle because they don't know how they can do best execution. They speak with one of our other managers that has found minority brokers, or they speak with minority brokers that have had success with our other managers, and suddenly they build relationships, and then they pass these goals very quickly. And some of our largest managers have had this experience. So if you're one of the managers that's struggling to meet these goals, we'd love to work with you. Mark Pendarvis is in the house. Mark, can you stand up? There he is over there. We're going to have an informal session upstairs I urge you to talk with Mark. He can get you set up to meet some of these brokers or talk with some of our other managers. This is important, and we do ask this of you, that you give this a shot, just like we are very focused on finding a good diversity practice among your operations. There are a couple things that we ask of all managers that are operational. They're nitty-gritty. Our operations weren't the greatest. I spoke just a few minutes ago to a manager who had worked for us 10 years ago. We fired him, so I won't name him, and then we just recently rehired him. And we've been, putting the money to work and so forth. And I just saw him having coffee. I said, "How are we doing with you?" He said, "What do you mean, how are we doing?" I said, "Well, operationally, are we easy to work with?" He said, "I got to tell you, Scott, the difference between the Bureau of Asset Management now and the Bureau of Asset Management I dealt with 10 years ago is like night and day. I don't know what you guys are doing, but it's working well." So we're geared up now. We spent a lot of time on the inner workings of the Bureau of Asset Management so that we can operate smoothly with you. These are our metrics that we're looking at. We want you to get us all price challenges in 2 days, preliminary detailed accounting reconciliation in 3 days, and so forth, all the way down. This is our scorecard, our operational scorecard for you, the manager. We were putting this on the web as you speak, so you don't have to take pictures. I see some folks in the back. But this is what we ask of you, and it's important. And obviously, we look at investment performance, we look at investment process, and so forth. But if you're failing on this stuff, it's going to be a problem for us, and it'll definitely hurt you. So this is achievable. We're not in a position yet to be giving much instruction operationally, but we can work with you or introduce you to folks that meet these standards easily. But we do ask that all of our managers meet these standards. So that's fine. I know what many of you are thinking of. Well, I got a few standards for you, Scott, that you could do. And I actually have gotten a little feedback over the years about that. The first thing that people said over and over and over again is, "What is with this dollar cap on our contracts? Nobody else has this. It makes no sense. It's just completely arcane, and it requires that we sort of, we're an asset-based fee, and it requires that if we have a 10-year contract with you, that we estimate the market level in 10 years. And if we guess low, you don't pay us anything. That's preposterous." We took a look at it. Didn't make any sense to me on the outset, and so, of course, I didn't say that. But we looked closely at it. We talked all over the department. We talked to the accountants. We talked to all the folks that have the various standards, and we concluded there was no good reason for it. So we got rid of it. And now all of our contracts are basic asset-based contracts, which everybody else was doing. But I hope that proves that we're listening. I know for some of the smaller firms, the emerging firms out there, this is a big deal. This was causing you real pain in certain environments, and so we did away with it. It's completely gone. The other thing was, you said, you could be a little faster in paying us. Usually we hear from people in 30 days, but 30 months is a little much. And so I actually saw one that was like 3 years old that I couldn't believe it. So we went to work on this. And Kara Schnapper is standing in the back of the room, and David Jetter, I saw David, he's there, he's back over there. They went to work on this. And I asked casually one day, how fast should we be able to pay? And I think these two guys are still regretting it. Somebody said 18 days. So I stood up here last year and I said, we're going to do it in 18 days. They weren't too happy with me about that. But they've gone out and they've done it. We were about this time last year at 35 days on average in paying, which is not terrible. It was a lot better than when we started. We're now going to get to about 15 days, but at present, we're in the 62% range in terms of the folks that are meeting that, where we're meeting that 18-day threshold for you. So there should be a third of you that are saying, well, you're not there yet, and 2/3 of you that are happy. And we want to get all of you to the point where we're paying our bills quickly. We owe that to you. You're our partner, and we appreciate the work that you do for New York City. We want to show it to you. So, as I said at the outset, in addition to paying our bills on time, this is what you can expect from us. You can expect that we are a manager that's going to have a long-term focus. And we have hired you because of your long-term focus. Our liabilities are very long, like any large public pension fund. We have to resist the human temptations, the group biases that lead us all to make short-term decisions, to overreact to recent data. We're working very hard to not be part of that problem so that you can feel that you've got a long-term partner with us. One of the ways that we'll show this is that we hope to be a provider of countercyclical cash flows, to be giving you money when all your retail clients are heading for the exits because you've had a bad quarter. The flip side of that is that we'll be taking money away when you're winning lots of awards and your results are at the top of the charts, because we want to be countercyclical. We think that'll pay off over time. But in order to do that, we have to know you very well. We have to have a deep understanding of your practice. One of the basic things that we started doing a couple years ago is we came out and visited you at your shop. How the heck are we going to understand your shop if we just have the IR person in once a quarter to tell us how things went? Or the CEO drops in from time to time, or we see him or her at a conference. There we're dealing with the publicity machine, and that is no way to get to know a manager. So our teams now show up at your offices. They'll spend the day. They'll dig around. They'll want to know everything about your investment process. Increasingly, you'll find that they want to know about your operations. And this leads to a depth of understanding that will enable us to be long-term partners with you and have the courage of conviction to provide countercyclical cash flows. So that's the deal as we see it. We're now going to spend some time, if I haven't forgotten a slide, nope. We'll just spend a couple minutes on questions if anyone has any questions, and then I'm going to bring the panels up here, which will tell you in greater depth about how this happens. So, do I have any questions in the audience? Anybody who we're still not paying in a 30-month period, feel free to shoot at me. Now, we have most of our, oh, there we go. Yes, ma'am.
Good morning. Janita Mazel from LM Capital. Can you talk a little bit about your asset allocation as it stands right now and any anticipated changes?
Yeah, so we went through an asset, the question, well, you have a microphone, so you heard her. It's going to repeat, good instinct, I was going to repeat the question, and I realized she had a mic. The question on asset allocation. We had not done an asset allocation in the Bureau of Asset Management, the city, for some time. We believe that, and our consultants believe that every 2 or 3 years, the strategic asset allocation should be revisited. We went through a big change in a big asset allocation that concluded early this year. When you have 5 systems, 12 consultants, and 58 trustees, the process of getting a common asset allocation is not a straightforward one. And so we had a very elaborate process. I will tell you there was a fierce debate amongst our advisors about one asset class, and we had all the consultants there and had really one of the more enjoyable discussions that we've seen, where they brought their subject matter experts in, and we hashed it out in front of the trustees. And I think that's one of the strengths of all the folks that we have. But the asset allocation remains similar in most aspects. We have a lower allocation to mortgages, to investment-grade fixed income, where the yields and the structure in the industry have really reached a point where we're not getting paid much for taking modest levels of risk. We have more Treasury allocations than we probably ever had before. We will have at the end of the cycle a larger allocation to real estate, a larger allocation to alternative credit, and a smaller allocation to public equities on the margins. But what we're left with is a portfolio that is pretty similar. I meant to say U.S. equities. Is pretty similar in terms of its overall structure, 50% or so in equities of all types. And really 70% of the portfolio is in assets where we're trying to capture a risk premium, where we're trying to grow the assets over time, with the remainder of the portfolio being fairly equally divided between assets that we hold for, excuse me, their deflation-fighting characteristics, and the other 15% or so with assets that have good inflation-fighting characteristics. And so that's not terribly different, but we made the structural changes that I mentioned. Other questions? Yes, sir, in the back.
Hi, my name is Cindy from Sustainable Insight Capital Management. You touched a little bit about requiring managers to report on carbon footprint. Can you elaborate a little more about your approach to environmental social governance, both in the short run and the long run? Thank you.
No. Next question. This is, for us, fairly new. And we've been very focused on this in the corporate governance area through the lens of proxy access. But to take a holistic look at the sustainability in our portfolio is sort of a fresh ambition for the 5 systems. We have hired a consultant recently to advise us on this whole approach. And we've also hired a separate consultant to document the carbon footprint analysis. And we have yet to get the benefits of that, so we're early days. I can say personally that part of my prior life was at TI-CREF, where we built one of the largest sustainability franchises in the world in our SRI portfolios. I was on the board of APG, ABP in the Netherlands for many years, who I believe is the leader in terms of embedding sustainability in a sustainability lens into their investment process. So it's familiar territory for me. It's new territory for New York City, and I can't wait to come back and talk about it in another year. But so far, what we've done is hire consultants. Next question. Yes, sir.
Chad Elson, the Chief Operating Officer of Creval Capital Management. We are a short-biased equity fund that's doing okay in this irrationally exuberant market. Like Nietzsche said, that which doesn't kill me makes me stronger. Wondered, when you talk about counter-cyclical investment, are you looking at long-short decisions that funds might be making? And then secondly, is there a minimum amount of AUM that one has to sport in order to have a relationship? Clearly, most institutions don't want to be more than, let's say, 10% of your AUM. And a $1 million investment on your part might not seem to make sense. You have to pay as much attention to that as $100 million. Makes a big difference to emerging managers, though. So I wondered if there is a minimum that you have to sport.
Yeah, we do, like many institutions, have a rule about not being more than X% of a manager's assets. And so that keeps us from overwhelming a manager with money early in their life. We make an exception to our minimums for our emerging manager programs. And certainly in the spaces where we're using an emerging manager of managers, the individual investments that they're making are at very small increments. And the way we work it is that the emerging manager of managers is an extension of our staff. And they're dealing with smaller holdings than we would be able, than we're staffed to deal with. And so some of them have very small holdings. And then what we want to do is to reach in and invest directly when we develop enough confidence and the assets in the firm can support a larger investment. So in a regular investment, in the public space, 50 million would be a very small investment for us. 100 million would still be a small investment for us. And so we're very anxious to find emerging managers that we believe in enough to invest directly. And so we might make some exceptions. I don't think there's any fast rule, but that gives you a flavor of the likely size. And so in the public space, this is why we work almost exclusively with fund of funds to make sure we can be there in the early days of an emerging manager's life. Other questions? Let's get one from another part of the room. Yes, sir. Excuse me.
Yes, thanks. Good morning. I'm Rob Colarina, AIAC. Could you speak a little bit about your geographic distribution within the country and then a little bit overseas, please?
Our geographic, you mean of our staff or our investments? Yeah. Yeah. In the equity space, we're divided in the public equity space. About 2/3 of the money is inside the U.S. and the rest is outside the U.S., with twice the money if it's outside the U.S. In the EFA space, and about half that amount in emerging markets. So that's the public equity where you have the bulk of the international exposure. We have little to no non-U.S. exposure in the public fixed income space, and I think no non-dollar or virtually no non-dollar exposure in the public fixed income space. In the private markets, it varies over time. You still have, I don't have a number in my head, but it's 75% plus when you look across the private markets inside the U.S. And in some parts of the portfolio, private equity, real estate, you find European exposure, still very little exposure in Asia, but some. Am I, Alex, pass the test? Okay. Anybody else before we get to the panels? How are we doing on time? Yeah, one or two. One. What does this mean? Anybody? Know what that means?
I'm the last question.
I don't think it's good. Yeah.
All right. So my name
Last question.
My name is Medina Jett. I am the founder and president of Integrated Compliance Solutions Group, which is a compliance consulting firm that serves a lot of the firms in this room. And you talked about the commitment that asset managers will use minority and women-owned broker-dealers. But I wonder if there's a similar expectation that they will use other minority and women-owned service providers in general that exist within this industry but are not specifically managers.
And Jimmy Ann does our scoring when we're doing the scoring. Do we take a look at their minority vendor? We look at supplier diversity. So it is one of the things that we do look at when we're giving the award. Yeah, absolutely. Okay, thank you very much. I'm going to turn over the floor here to Alex Dunier, who's one of the. Now, it's pretty sad when your PR person has to start the applause, but I'll accept it. I just, that's one of the things I'll try to do better next year. So I'm going to bring Alex Dunier and the privates team up here. We're going to have a little panel session where Alex is going to interview the team about some of these things we've been talking about. Alex is the Deputy CIO in charge of private markets, and after that, Mike Haddad, who's Deputy CIO of public and tradable markets, is going to come up here. Then I'll be back to talk to a couple of managers. Thanks very much.
good morning. First of all, wanted to thank the UFT for once again hosting us this year in this wonderful building and room. We appreciate the accommodations, and special thanks to the chairman, Mr. Mel Aronson. Also want to thank the comptroller and his team, our distinguished trustees, and of course our CIO for his partnership and steady leadership. This morning, what we wanted to do was really share with all of you a little bit of insight as to how the private markets team is thinking about each of their portfolios, to give you a sense of how we're thinking about trends, opportunities, challenges, and give you also a sense for what we are targeting with regards to new commitments in each of these asset classes. Today we have Yvonne Nelson, Head of Real Estate, to my immediate left.
Good morning.
We have Petya Nikolova, Head of Infrastructure. Wesley Pulisic, Head of Alternative Credit. I also lead our day-to-day activities in private equity, so I'll be supplying remarks on behalf of private equity. We also have one of our senior members of the private equity team, David Enriquez, with us as well. In addition, here in the front row, to my left, we have the consultants, specialty consultants that serve the New York City pension plans in all of these private market asset classes. Now, together, the team that you see here on stage is managing about $30 billion of plan AUM. So let me start by having each asset class head kind of provide a brief overview of your portfolio, giving all of us a sense for size, subsectors of focus, emerging manager investment programs, and annual pacing target. Yvonne, let's start with real estate.
Okay. Can you all hear me? Okay, great. So real estate. Now you heard Scott mention earlier in response to the question on asset allocation. He highlighted the fact that real estate received an increase in its allocation that was one of the takeaways from the asset allocation exercise. As you know, real estate has been enjoying a rather robust recovery 6-7 years into it. And so we were thrilled to have a 40% increase in our allocation, but we were very cautious about what we were going to do with it, given the historical pattern of real estate being a cyclical asset class and having, its, peaks and valleys. So we were very much, thank you very much, but, you're not going to see, any incremental deployment of capital in this environment. We're going to be very careful. The trustees support the real estate program, and one of the things that they do know is that we bring them the best ideas, and to the extent that we try to implement those best ideas within the construct of our annual plan that's approved by the trustees, and also in terms of the pace of the deployment of capital from our consultants, all of that kind of fits together into what we ultimately do with the program. So very excited about the new money and some of the things that you will see and some of the themes that we talked about with our trustees is being a bit defensive because, as I said, we are coming toward the end of the recovery. I'll talk later about some of the inflection points we've already seen in some of the real estate benchmarks. And so while real estate is lost some of its momentum, it's actually performing as expected. It's performing as it has over decades, and it's returning to its more normal pace of performance. And so that's some of the things that we are seeing and addressing in our annual plan. Also, an integral part of that annual plan, as Scott mentioned, is our initiative to identify and reach out to more emerging managers in the space. what we've done, and we've been able to deploy some capital in 15 and 16 with both emerging managers and also with women and minority-owned firms, so we're very happy about that. In the emerging manager space, what we recognize is that we had to kind of broaden our execution. We were making commitments to commingled funds, and there were probably very few that would kind of fit through our criteria. And so we wanted to embrace early stage managers, and we've done that through a co-investment program with Artemis. So that's the emerging manager part, and it's been successful to date, but early days. So you'll be hearing more about that during the panel discussion. So I hope I covered pacing, emerging manager. Oh, size of portfolio. We are about $8 billion in the ground right now. With unfunded commitments, we're about $11.8 billion in exposure in real estate. Thanks.
Well, thank you, Yvonne. Now moving to infrastructure investments, which is actually one of the newer asset classes within the New York City Pension Plan. And Petya Nikolova has led that effort in building that program since day one. Tell us a little bit, Petya, about infrastructure.
Good morning. As Alex mentioned, infrastructure is the newest asset class in the portfolio, and we started 5 years ago. It took a little bit of time to set up the policy guidelines, so effectively we have been investing for the last 4 years. A big development for us as well, as a result of the asset allocation that Scott and Yvonne mentioned, was that for the first time we received a separate allocation. In the beginning, we were part of real assets, sharing an allocation with real estate, and now we have an allocation of 2% of total AUM, and we are thankful for the trust that we were given to manage and invest this allocation. Thank you, Yvonne. So where are we today? What have we been doing for the last 4 years? We are currently at $2.3 billion, roughly speaking, invested and committed, and we hope to be around $3 billion by the end of the year. The program is global, so we would over time have North American and international exposure, primarily OECD, but we have looked at the emerging markets as well, looking for opportunities that are de-risked enough to fit our portfolio. In terms of pacing, as you've heard from the presentation earlier today, our AUM is growing up, so we expect that we would need to deploy more capital over the next year, assuming that the markets continue developing the same way and not the other way around. To echo Yvonne, we would be very disciplined because we do see a lot of competition in the market. So that's something that we'll be keeping in mind going forward.
Thank you, Petya. And Wesley, I guess where I would like to start with alternative credit is just a definition. How does New York City and how do you define alternative credit?
Sure. Good morning. I advise New York City trustees on their alternative credit portfolio. That comprises 3 separate and distinct strategies. That's high yield, bank loans, and opportunistic fixed income. I'll be talking about opportunistic fixed income here on this panel. And so let me kind of define that first. What is the opportunity set in opportunistic before we go on to maybe some more of the portfolio metrics? So it's a broad opportunity set within performing and non-performing credit. On the performing side, we have the lending strategies that you're probably aware of. Senior direct lending, unitranche lending, subordinated, mezzanine, and then separate from that, but still in performing, we have structured products, CLOs, CMBS, RMBS, and then going to the non-performing side, we have single name stress and distress managers, NPL portfolios, and debt for control. we can seek exposure in those strategies through corporates, real estate, infrastructure, asset-backed, consumers, municipals, and sovereigns. So, and we can further diversify by geography, by size of transaction, and even by industry specialization. Yes, it's a broad exposure. And as I said, it's a broad opportunity set, and we don't necessarily look for exposure across these places. Certainly some don't meet the return threshold that we're looking for, but that's where we're fishing, so to speak. In terms of the portfolio itself, we have about 4.6 billion invested, another 1.3 in dry powder, undrawn capital, and another portion that we still have to put out. I won't mention that number in this room. This thing on. The target asset allocation is 5% for the overall opportunistic program. We don't have a specialist consultant, but we do work with the generalist consultants here. I'll name them. They're in your brochures, I think. NEPC, Callan, Wilshire, and Rocaton. And currently the program has about 16 mandates across 14 managers. So it is a concentrated portfolio, but we do have one MWBE manager, which we're proud of in that exposure. In terms of strategic priorities, should I get into that a little bit? Okay.
We'll get to that. Thank you, Wesley. Turning to private equity. So our private equity portfolio today is about over $11 billion of NAV, about $18 billion of exposure to the asset class. We are investing in most private equity sub-strategies, so it's buyouts, growth equity, special situations, turnarounds, and secondaries. However, we do not invest in venture strategies. The portfolio is geographically diversified, as Scott mentioned, primarily focused in North America. We also have exposure to Western Europe. We are deploying capital today at a pace of approximately $2.5 billion annually. In private equity, we have a dedicated emerging manager program that is focused on MWBE managers. It's a program that we are all very proud of. We began investing with emerging managers in 2000, and as I was mentioned earlier, we now have about 20% of the private equity portfolio is invested with MWBEs. We launched our direct emerging manager program in 2012. That's when I joined the New York City pension funds with a $425 million allocation, all of which has been allocated. And that was dedicated to funds 1, 2, and 3, raising up to $1 billion. That's New York City's definition of emerging manager. We re-upped that allocation in June of 2015 with an additional $500 million capital commitment, which is currently being deployed. We also expanded the program at that time to include managers that were raising up to $3 billion, the concept of a graduation program that you have heard me speak of before. However, it is important to note that that aggregate or incremental, $500 million of capital is ring-fenced and solely dedicated to funds 1, 2, and 3, raising up to $1 billion in capital. Now I'd like to delve a little deeper, and Wesley, I'll turn to you first, since you anticipated the question, to discuss the strategic priorities that we have in each of our portfolios. So in alternative credit, what is occupying kind of your time and focus?
Well, we're very generally, we're trying to get up to the 5% target asset allocation that we recently received. Actually, it stayed the same, 5%, that's what it was, and that's what it remains. So we're trying to deploy capital in the space. I mentioned earlier we have we do have a lot of exposure right now, probably slightly overweight in that single name stressed and distressed corporate credit box, right? So if you're a manager in this room that's owned Algeco Scotsman or Cengage Learning in the past 2 years, probably a good trade. You might have made money, but we're just looking for something a little bit more, at this point, differentiated than that, based on the exposure we currently have in the portfolio. To balance the volatility that comes from having that type of exposure, we are looking at direct lending strategies as an example of something that we've been looking at. But and that's across in both in the U.S. and in Europe, and we should be fulfilling that allocation within, I'd say, the next 2 or 3 quarters.
Thank you, Wesley. And Petya, some of the priorities in infrastructure?
So we're a little bit different from the OFI portfolio in that we're still in a very active building mode of the portfolio. And we continue to look for the best ideas, the best-in-class managers, and try to build a portfolio where we have different strategies that are complementary. And I mentioned briefly emerging markets may be a fit, and we did invest in emerging markets so that we have a different exposure to different parts of the world, different regulatory regimes, different political systems, again, the risk being mitigated. We also added a secondary strategy, again, giving us a different access, a different type of dynamics while still investing in infrastructure core assets. So this continues to be top of mind. How do we build a portfolio that can withstand different scenarios and different environments? Another, and I think this would be an answer every year and every time, would be negotiate good terms, fee terms, especially, has been a priority. And in this environment where we all see the returns being under stress, fees become even more important. They could actually have a significant impact on the net return. So we have been extremely focused on that. And finally, we continue to look for ways to access the market beyond fund structures. So while we haven't yet been able to find the right opportunity, we do continue to actively look for these opportunities, be it separate accounts or partnerships with other pension plans or co-investments, just different ways of accessing the market. So I would say these are the 3 priorities for us.
That's very helpful. Yvonne, as you mentioned, real estate is the beneficiary of an increased target allocation, long-term target allocation. Some may see that as a good thing. Some may see that as a challenge in today's current market environment. Help us understand how you're thinking about the real estate portfolio today, given where we are in the cycle and some of the strategic priorities that you're focused on.
So let me first talk about tactically what we're doing. And I mentioned the annual plan because that is a product of a collaboration between the consultants and the trustees about how we're going to deploy the capital that's been granted to a particular asset class based on what's going on in the market today. And as I mentioned before, we're going into another phase on real estate. It was obvious that it was pretty robust and we were going through a recovery. Last year, we were wondering whether or not we were topping out. If you look at the real estate benchmark for 2016, it was a single-digit number for the first time in 6 years. So we were enjoying double-digit returns for the past 6 years, and now all of a sudden it's single-digit. But I remind you again that the historical return for real estate is about 9%, the 30-year number. And so that kind of shaped our annual plan. So we, as I mentioned before, we're thinking about being defensive. And what do I mean by that? To the extent that we can preserve the capital, to the extent that we can identify opportunities that provided immediate income-oriented returns, we did that. To the extent that we were able to identify best-in-class debt managers where the investors are not in the first loss position, the borrower is. We were looking for ability to protect our downside. And so last year we were able to commit close to $2 billion, and about $850 million of that was in debt vehicles. Another tactical play for us is that our portfolio was underweight and industrial. And as you know, if you know real estate, I'll just tell you that the industrial sector was the one of the best performing sectors for some time, and we happen to be underweight in that. And so we had been evaluating some choices and made some decisions and was able to commit to $500 million to two industrial managers. And I actually continued that into 2017. We already closed on an industrial deal. If I can kind of just talk about who our partners are when we do that, when we execute those tactical plans. Real estate has 75 investments at this point. We have about 48 managers. What's interesting about the manager count is that I would say that about 27 of those relationships are partners that we have invested with repeatedly. And the fact that pension funds, for obvious reasons, want to streamline the number of relationships is something that we do as well. And so that number that I talked about, that exposure number that was close to $12 million, is actually being managed by probably about those top 27 relationships. So over time, we've been able to kind of migrate the decisions, the manager selection decisions that we've been making, of course, to folks that are able to perform cycle in and cycle out. That's important. But as Petya mentioned, we're also looking for partners that are flexible and can empathize with our views on governance, our views on fees. So in totality, we do have a core group of partners, and that's how we have been able to kind of implement the real estate program to date. Longer term, with that new allocation, I see that we do have the right tools today, larger allocation, more staff coming. This is not a wish list, really. You're going to meet a guy today. He's new. He just started this week. So we have real people, we have resources, and so that's how we're going to be equipped for the longer-term challenge of deploying capital.
Thanks, Yvonne. And turning to private equity for a second, there are several priorities that are occupying the investment team's time and attention. I would say first and foremost, it's improving returns, both on an absolute basis and relative to our public market benchmark. We are benchmarked against a Russell 3000, and our expectation is to exceed that benchmark by 300 basis points or more over the long term. And that's not easy to do. We are achieving improving portfolio returns really by concentrating our commitments. That's one of the priorities that we have set ourselves on, and the course that we have set ourselves on over the last 5 years with the help of our private equity consultants, Hamilton Lane and Stepstone. It's important to understand that today, New York City, we have been invested in private equity since the mid to late 90s, and we have 120 active GP relationships. And that does not include the GPs that underlie our fund of funds. 120, and that's across 220 partnerships, way over diversified. And one of the things that we've been really focused on is narrowing that universe. And frankly, it should probably be about half that, and we are working on that. As Petya mentioned, a strategic priority for all of us, not just in private equity, is really fees and negotiating the most attractive packages, fee structures and packages for our beneficiaries. I think one other area I'd like to mention that we're spending time in private markets, private equity, in particular, is co-investments. We are actively looking at the merits and risks of expanding our co-investments in our portfolio. It is still early days, so we may decide not to pursue an extension or an expansion of investing or an expansion of co-investments in our portfolio, but we are engaging our boards in this area. I think now, and I see I'm getting the sign, just want to spend a little time on kind of the current market environment, kind of geopolitical trends, and how that's impacting and influencing the capital deployment decisions that we're making. Yvonne, I'll turn it back to you. And I guess what I want to understand, given how you mentioned how you're thinking about strategic priorities and the portfolio, how are you thinking about and how you are assessing core and core plus strategies on the one hand versus value add, and opportunistic real estate strategies? What's interesting to you, and where are you being cautious?
We have been focused, as I mentioned before, our annual plan has focusing on debt and industrial. Why? Because of the downside protection and the emphasis on income. So most of our commitments have been in what I would call the core plus value area, and that's when we're aligning our capital with managers that are able to kind of correct some minor deficiencies in the real estate, stabilize it, say, within 12 or 18 months, as opposed to more opportunistic strategies that may encompass some degree of speculation or unentitled work or anything like that. So we've kind of been focused on the middle core real estate. You can read in your own personal finance. We know that real estate is really topping out these days. It's a struggle for us to identify, I guess, a fairly priced core opportunities. But fortunately, our portfolio is diversified across investment strategies. So when one strategy becomes too pricey, for example, core, and if you feel that some opportunistic strategies are a little bit too risky, then we kind of converge to the middle. And that's what we've been doing in 15, 16, and probably in the near term is what our approach is going to be in deploying the capital.
Thank you. Petya, switching gears a little bit, I want to discuss, you have in the portfolio the ability to invest in both equity and debt. Is infrastructure debt attractive to you today? How are you thinking about debt, products, and infrastructure in terms of the portfolio construction of the infrastructure portfolio?
We do have the ability, absolutely, to invest in both equity and debt. Debt has been an interesting development over the last few years, infrastructure debt in the market, and we have seen a lot of strategies coming up, taking the void that has been created by the withdrawal of project finance banks, especially the Europeans. So we have been looking at that to see if it could play a more defensive role and provide a good relative value. It depends on what kind of debt we look at. Is it the very senior part of the structure? Is it the mezz part of the structure? So we find that set of opportunities interesting, especially the ones that can provide a little bit higher return for probably taking a little bit higher risk from a debt point of view, but still lower risk than equity, and potentially providing a similar to core equity return with lower risk. So we absolutely have been looking at the space and find it interesting.
Thank you. Wesley, next question for you. I wanted to address fund structure, and as it pertains to alternative credit. Unlike private equity, real estate, infrastructure, or I guess generally speaking today, we are investing primarily through commingled funds. That's not the case in the alternative credit portfolio. Can you discuss the rationale for that? Is separately managed accounts really the only way that you invest in parts of your portfolio? Is it because of the certain subsectors are better for investing through separately managed account? Give the audience a sense for different fund structures and the use of separately managed accounts in particular in alternative credit.
Sure. Of the $5.9 billion exposure in OFI, about 2/3 of that is in separate accounts. We do recommend to trustees commingled funds as well, but those tend to be more niche strategies or smaller managers. The idea behind the OFI SMAs was first, we approached a few broad credit managers and asked them, would you be interested in doing a flexible partnership with us? And what we mean by partnership is to look at us as an evergreen source of capital and a flexible source of capital. So evergreen in the sense that there is no time frame on this relationship. This can go into perpetuity as long as you perform, of course. And flexibility in capital in terms of we will provide, you can call capital from us when you see the opportunities, and you can distribute it back when you don't see opportunities. And believe it or not, we actually do have managers that distribute money back to us. Believe it or not. If it's done right, the manager can potentially avoid vintage issues that we've seen in private asset classes. So what we look for in a broad credit manager for an SMA is someone that has a really good track record across multiple products within their house, and we look for the ability for the manager to be able to make relative value decisions among those strategies in which to deploy our capital. And then there's an additional kind of thing that they must be able to do is actually they have to be able to make the call of when to turn it on and off and to call capital or distribute it back. So sometimes we find organizations that have all of those excellent products, but they don't necessarily have, they haven't convinced us that they have the ability to make those relative value decisions across the products. These are usually really siloed organizations. When it comes to a manager that has a single strategy, we approach them for an SMA when we're convinced that they have the origination capability to recycle our capital, again, potentially into perpetuity if they can do it well. So we do look at those things, and we do want to be a partner, but of course we do ask for a few other things. First, we always want to be paid on invested. We want to pay fees on invested capital, not on committed capital. We want to keep at least 70% of the alpha that you're generating above a public market equivalent benchmark. We need the ability for you to stop investing if we ask you to, and to put our investments into runoff if necessary. We ask for that legal right, although we haven't to date exercised it, so everybody knows. We do believe that fee compression is real. We will be a significant investor. We will write a large check. We will support new strategies that we have conviction in. But we will only do that if the price is right. And this comes from the trustees, this comes from Scott Evans, this comes across the public pension world. And in terms of the partnership, we do want a regular dialogue. We want to be seen as a partner. We want to see the investment memos. We want to participate, not participate, but sit in on investment committee meetings. We want to know about what you're looking at, what strategies you're thinking about, and don't assume that we can't invest in something. As I mentioned earlier, opportunistic credit is a broad opportunity set. So we just want to have that back and forth with you, and we're going to annoy you and ask you lots of questions. But again, that's what partners tend to do, and that's the way we see it, and that's how it's worked since OFI started.
That's very helpful, Wesley. Just a couple of comments on private equity and the current market environment and the impact it's having on the capital deployment decisions we're making. First of all, it's not lost upon us, and we think about this literally every day, that the elevated new deal valuations, elevated leverage, record dry powder in the market, and these increasing large funds that are being raised really are leading us to be very prudent in how we deploy capital in private equity. I would say one topic of heated discussion and very active discussion, both with our private equity team, our internal BAM, Bureau of Asset Management Investment Committee, and with our boards, is that while we have a pacing plan, which I alluded to earlier, is about $2.5 billion of deployment annually that has been carefully and thoughtfully constructed, we always think about our pacing plan as a roadmap, and it's not a target that we feel that we must hit. So we're looking to be very prudent and make the right decisions as we're deploying capital over the very long term in our private equity partnerships. What does that mean in practice? I will say buyouts, no surprise, is where we have the most concerns. I think that is where the team is spending a lot of time, being very careful in diligence in terms of diligence on managers, what are their go-to-market strategies, why are they differentiated and can deliver the returns that we're expecting in private equity in these markets. So we're spending a lot of time there. Where are we leaning in? When you think about it, in private equity, as you all know, we're making decisions today where capital is being deployed over the next 5 to 6 years. So we're looking to lean in to strategies that are value-oriented, special situations and special situations and turnaround. I think those are areas where we certainly believe, given where we are in terms of years, 7, 8 years into this cycle, that we believe there'll be opportunities or dislocations where our managers can take advantage. So that's how we're thinking about the private equity portfolio. Once again, primarily North America and Western European with regards to where we're deploying capital. Now, with the time I have left, I do want to get our consultants involved and ask a couple of questions. I'm going to start with real estate and Tony Fragapane, make sure I got that right. And Tony, I'm going to give you a slightly different question than maybe what we talked about. So a little bit of a curveball, but you are more than adequate to answer this. As Yvonne mentioned, we're looking and thinking and being challenged as to how we deploy capital in 2017. As someone who's a long-term consultant to many public pension plans in real estate, what lessons were learned 10 years ago? What are you not advising today, or said differently? What are you doing differently today in how you're advising New York City with regards to our real estate portfolio that you didn't do 10 years ago?
Right. So we've had a focus on leverage post-GFC because prior to the global financial crisis, a lot of the real estate assets were over-levered, and they subperformed coming out of the global financial crisis. So that was kind of the primary focus. And then, as Yvonne mentioned, we've focused on building portfolios with resilient income streams. So debt, private debt investments, and then recession-resistant investments as well, like self-storage and medical office, student housing. Steve, you want to add anything?
Yeah, the only thing, Steve Novak, I'll add from Cortland, is the big thing coming out of GFC, and even more important now, and one thing we're working on importantly with BAM, the control issues that you have, the structure in investing, and that's a big push, a big direction. One of the things we saw through the GFC, the investors that did the best had more control over their portfolios, i.e., so whereas we're going to continue to do commingled funds, there is going to be a significant push in real estate to do more of the structured SMAs or joint ventures, whatever you want to call it. Fees would be reduced, and there will be more control. And now with the ability of BAM increasing their staff and the ability then to manage those relationships more and more, the control is going to be a big push from our perspective working with BAM.
Thank you, Steve. Thank you, Tony. I'm getting this time that I have enough time for one more question. And I'm actually going to turn this to private equity because it is one of the topics, frankly, that has gotten the most airtime for me as an advisory board member on behalf of the New York City pension plans, particularly in our European portfolios, frankly, because I will say that our European managers tend to have more active advisory boards. I think our U.S. boards are moving in that direction. But a question for StepStone and Mike McCabe, and that is the use and the increased use, importantly, of fund subscription lines and credit lines, which primarily with our private equity funds have been designed to manage capital calls. And we've seen, honestly, certainly in the last 2.5 years, an explosion in their use, throughout all of our private equity funds. A couple of questions. What is StepStone's view on the use of credit lines, kind of the pros and the cons, when you think about the ability, if it's done correctly, particularly in this low yield environment, to improve IRR, allow GPs to earn carry kind of earlier, because there is a bump up potentially that you do get from these subscription lines. What does StepStone think about it, and how are you advising clients like New York City, to think about subscription lines and how should we evaluate both the benefits and the risks?
Sure. Thank you, Alex, and thank you, Scott. StepStone has been privileged to work with New York City employees, fire and police now for 7 years, and we've seen lots of changes in the market as we've recovered since the crisis. I'm Mike McCabe. I'm one of the partners here in New York City, also joined by other partners here at StepStone and a number of employees. So please feel free to reach out to any of us throughout the session. The question that Alex is asking is critical, and it's paramount to one of the things that we're seeing more so than anything else in amendments to limited partnership agreements. So let's first talk for a minute about what is a subscription line. General partners have the legal right to go and borrow money from a bank to fund activities ranging from capital calls to fund investments, management fees, and expenses. Why would they borrow money from a bank rather than call capital from their limited partner like New York City? That's question one. And question two is how much can they borrow, and for how long can that loan remain outstanding? So what we're seeing historically, and this is not new to the industry, is general partners oftentimes utilize this subscription for administrative reasons. They may have 100, 200, 300 limited partners in their fund, and so to minimize the administrative costs and time and burden of calling capital from 300 partners 5, 6, 7 times a year, they'll borrow money from the bank to bridge the capital call and maybe consolidate the capital call activity to maybe 2 or 3 in a given year. That's fine. We're used to that. That's an industry practice. That's a norm. What we're seeing in the last year or two are requests to limited partners like New York City and StepStone to make amendments to the limited partnership agreement, and those amendments are a lot more aggressive. They're asking us to reduce the number of restrictions associated with the use of these subscription lines. And they're being more aggressive in terms of how long they can keep these lines outstanding. So that makes us scratch our heads asking the question, well, why? Are there different purposes or uses for this capital that we're actually paying you to call capital to fund investments? Why are you borrowing from the bank? So the low interest rate environment has really been a trigger for the banks to actually go to the general partners and say, hey, I've got a great deal for you. At this low interest rate, you can borrow more money. And the general partners are thinking, well, if I can do that, maybe I can use that to bridge an investment rather than call capital. And if that investment can be returned quickly, well, that gets an incredibly high IRR. And if that's really the purpose, we're starting to wonder, are they trying to accelerate or play with the waterfall structure that is used to calculate the carried interest? And if those are some of the theses or uses behind it, we're pushing back on these amendments. The number one thing that we're recommending to all limited partners in this situation is to demand more transparency through side letters. Simply ask, we want to know exactly what you're using the sublines for, how long they remain outstanding, and so we can do the math, and we can figure out whether this is affecting the IRRs or not. So transparency is number one. And then number two would be, we do want restrictions on the amount of time they remain outstanding and the uses. We don't want it to be an open book, use it for any purpose whatsoever for as long as you'd like. So I think we're pushing back on the terms and we're demanding more transparency.
Thank you, Mike. That's very helpful. I think we are out of time. I think the one area that we will reserve for further discussion in our networking forum following this session has to do with our process. I think many of you, as I know, are existing managers, understand how our process works to get capital allocated from the New York City pension funds. But our networking forums will be there to answer all of your questions in much more detail. Once again, I thank you all. I thank my distinguished panel. I thank our consultants, Hamilton Lane and StepStone, Cortland, Townsend, NEPC, Callan, Wilshire, Rokaton. As Scott mentioned, we have a long roster of consultants, but we could not do it without them. So thank you very much. And And with that, please stay seated because we have the best fireside chat to come. I would now like to introduce Mike Haddad, who's our Deputy CIO for Public and Tradable Markets, who will lead a discussion, a public markets discussion. So with that, I turn it to Michael Haddad.
Test.
Okay. Good morning. Like Alex, I'd like to take just one quick second to thank the UFT for hosting the event, the controller for sponsoring the event, and his team for putting it all together, and of course everyone in the audience for being here today. My name is Mike Haddad. I'm the Deputy CIO of Public and Tradable Markets. And before I launch into the chat, I want to share with the room what I kind of call our day job. I've only been at on the public pension side for a little over a year, and it dawned on me after a few months. I kind of harangued Scott as like, what exactly it is that we're doing, and it's not as obvious as the answer was. So from my lens, what it is we do is trying to make a targeted rate of return. That targeted rate of return is 7%. That's mandated to us through the process with the actuary. But it's not just strictly 7% on a year-by-year basis. It's over a cycle. The contribution that the city makes is based upon some kind of 6-year complicated rolling average. So it doesn't mean if at month 8, if we're up 9%, that we take risk off the table and we just coast for the rest of the year. We have a lot of our money is indexed, which means that we are a slave to the market. So it's a 7% targeted rate of return over a long period of time that it is what we're doing. And what do we do? What value add do we do at BAM as the investment advisor? The primary things we do are asset allocation and manager selection. And within manager selection, that is hiring managers, that is firing managers, that is rebalancing assets amongst managers. And that consumes the crux of what we do on a daily basis. The gentleman to my left account for almost 75% of the assets under management at the Bureau. So with that, let me introduce first to my left Robert Fang, who is the head of fixed income. To his left is John Mersberg, head of public equities, and Neil Messing to his left. So as this is a fireside chat, I am going to sit with my... This one working too? Okay. Why don't we start off with a brief overview of each of your asset class, talk a little bit about AUM, how you subdivide into different components, any type of philosophical, active versus passive, sub-regions, maybe mention benchmarks, a little bit on fees. So just an overview on each one of those.
I'll start. Good morning, everyone. In public equity, we've got about $90 billion in AUM, so that's about 50% of the plan assets, and we break that down into 3 major asset classes: U.S. equity, developed ex-U.S., and emerging markets. U.S. equity represents the lion's share. It's about 62% of public equity. And in U.S. equity, the bulk of the assets are indexed or managed passively because we think there's less opportunity for active management in U.S. Developed ex-U.S. equity represents about 22% of the public equity allocation. And in contrast to U.S. equity, most of the developed ex-U.S. equity assets are managed actively. about 75%. And in emerging markets, they represent about 16% of total public equity, and there about 65% of the allocation is actively managed, again, because we think there's better opportunities for active management in emerging markets.
Hi, I'm Robert Fang, public fixed income. So roughly we have about 5 asset classes in public fixed income, the first being governments, which is about 7% of our overall allocation portfolio. So if you're looking at 180 million or so, 180 billion, sorry, 180 billion or so, we're looking at, yeah, it went up. About 7% of that is about 12 billion. So 7% of that is in governments, 3% is in mortgages, 6% is in investment grade credit. We have 4% in tips, and then we have about 3% in cash, economically targeted investments, which is managed by my colleague Brian Cook over here, as well as the emerging managers, developing managers are in that category as well. When we look at fixed income, our prior allocation had us about 1% in passive. We've actually moved that to about two-thirds of our fixed income, public fixed income allocations now passive. So, they're in these sectors where it's hard to really generate alpha. It's more beta bets. So, in your government sector, in your tip sector, those are the asset classes where we generally have moved to a mixture of mostly passive and a little bit of active. All our assets are basically in the U.S. We do not do any non-dollar assets. Everything is hedged back. We do have as part of the investment grade portfolios, there's a large allocation, in the index to Yankees. So, and that's pretty much the particulars of the asset classes. We actually get fairly low fees. Our fees are generally, I would say, under 15 basis points overall for all the asset classes.
Hi, I'm Neil Messing. I do hedge funds. I think you'll hear from everybody today that we prefer low fees in all the asset classes. So on the hedge fund side, we have probably a little bit more of our, more than half of our portfolio in beta neutral type strategies. So that's managed futures, either quantitative or discretionary, developed markets or emerging markets, and then also some equity market neutral quantitative strategies. The say remaining 40% of the portfolio is split about equally between equity long short and then event-driven funds. We don't do a lot of credit in the hedge fund portfolio. That's really Wesley. We don't do a lot of equities, equity long short in the hedge fund portfolio because we have so much long only money in equities, and you should talk to John. So.
Thanks. Let's talk a little bit about how a manager gets brought into the fold at BAM. So what is a manager search process? How has that evolved over the years from an RFP to a manager search? And share with the room the process that we go through from the consultant's role to what a committee is in BAM, the investment committee, and then all the way up to the board. So I'll let either John or Robert start with that one.
I'll take that. So we typically launch a manager search to find products to help meet the system's asset allocations. And we can start one because of a change in the asset allocation, expiration of existing contracts, or the need to supplement managers, the manager pool, or to replace current managers that might not be performing well. And we work with the consultants to determine the scope of the search, including things like minimum requirements, AUM, track record, et cetera. In public equity and public fixed income, we used to use an RFP process, but we started a new consultant-driven process back in 2011. So our process starts with the consultants. We have 5 general consultants. They all have representatives here today. They're Callan, NEPC, Rocaton, Siegel Marco Advisors, and Wilshire. So to be considered part of the search, you need to make sure that you have your firm's information in the eVestment database, Wilshire's database, and Callan's database. That's where the manager screening process begins. Then next, after we get kind of recommendations from the consultants, where we have multiple recommendations, the BAM asset team does additional due diligence. So where there's overlap, we'll send those firms a due diligence questionnaire and review that. We'll go out and meet the firms to continue the due diligence. And of course, when we do that, we look at, pretty much what you would expect. We look at the organization and firm, the product team, their philosophy and process, as well as risk management, compliance, and the particular product's performance relative to the market environment. We recognize that not all products perform well in all environments. And I think as Scott and everyone has mentioned, we don't want to be pro-cyclical. We want to, thank you, be more counter-cyclical. And then based on our due diligence review, we make recommendations to the BAM Investment Committee. That includes Scott, Mike, Alex, and the other asset class heads. And then if after the BAM IC review, if they approve, we bring it to the boards, and then it's up to the boards, ultimately up to the boards to either hire or fire managers. That's pretty much the public process in a nutshell.
Robert, is that different for our public fixed income?
No, we kind of have the same process, so there's nothing that really changes from that.
Neil, do you have a manager search process?
Yes, ours is very different. On the hedge fund side, we have a specialist consultant, Axia. They do all of our operational due diligence for us. We do all of our own investment due diligence. And we probably follow a process very similar to a fund of hedge funds. So we would request a marketing presentation. If we like what we see, then we'll come and visit you, meet with your team, learn more about your strategy, et cetera, et cetera. If we decide that we like your fund and want to go forward, we bring you to our investment committee. Our investment committee gives us an approval on the investment, and then we bring you to our boards, and our boards do the same.
So that's the process for the larger, well-resourced firms, if you will. Could you share with us in each of your asset classes if you have a different process for smaller managers, or if you have an emerging managers program, and how the emerging managers program works? How does that process work? Is it similar monitoring? And then, importantly, is there some type of graduation policy that is available to our emerging managers?
So I'll handle the first part of that question, which is more of the monitoring and how we look at managers. The monitoring process is the most vital process that we go through. To monitor our managers is to understand their performance, to understand their process. And we kind of take a look at, what's really important is we do a due diligence meeting that, Scott had said, this is what we are doing with our managers right now. That's a full day. Sometimes it could take longer than a day process in which we kind of try to dig up everything we can about, what the manager is actually doing. And what's, I think, really important is it's not so much what the manager shows us, it's what the manager doesn't want to show us, right? And then we see their first agenda list, and then we say, look, this is what we'd like to see. And I think that is just vital because it really, really helps us understand a lot of different things. Now, the second part about that is, we do quarterly calls. Some managers, we even started doing monthly calls. So we're going to be more active in terms of our talking to our managers and understanding. if there's anything that changes with their process, if there's anything that changes, organizationally, which is so important for us. So besides that, this is just a general reporting, and I can't emphasize how much the reporting functions are really helpful for us to really understand, the day-to-day performance. The month-to-month performance impacts. Attribution. As you know, we're kind of trying to get some systems, and we're actually trying to get some tools to help us look at these accounts better. I think with the reporting function from our managers to us, we kind of are blind in a way, but it's really for them to show us and them to get us all the stuff we need. And it starts with the quarterly questionnaire, which talks about their performance during the quarter and how they've done, ups and downs, attribution, and everything else organizational-wise as well.
Before you pass it off, emerging manager program in fixed income?
We do have an emerging manager program in fixed income. We have an emerging manager program and a developing manager program. The developing manager program is the graduation kind of from emerging manager program. Now, we look at all managers the same, large or small. We have the same criteria for all our manager selection. No manager is any different. We have a process that we go through that John had explained. So right now, currently, we have about $1 billion for both the emerging managers and the developing managers. So,
John, in public equity, do you have an emerging managers program?
We do. We do have an emerging manager program in public equity, and we implement that through a fund of funds structure. We've hired 4 fund of funds in public equity. They're Bivium, FIS, Leading Edge, and Legato, and I believe they all have representatives here today. And our emerging manager program was recently realigned to be more consistent with our overall asset allocation, where we're more active in non-U.S. equity than we are in U.S. equity. And now our fund of funds have discretion to hire managers with very low AUM levels just starting out, and they can hire managers with up to $2 billion in U.S. equity and up to $3 billion in non-U.S. equity. And we currently have 24 sub-managers with over 100 accounts in the program. And our expectation is that those fund of funds will add value net of fees over a market cycle. Also, the PPB rules now allow us to graduate a sub-manager from the fund-to-fund program. So, and as a result of that change, what we've been doing is asking the fund-to-funds, who do you think is ready for graduation? And we've had some initial due diligence meetings with some of those sub-managers. But since we recently kind of realigned the program to a non-U.S. structure, really most of the sub-managers in the fund are brand new to us.
Why the realignment away from to international equities?
A combination of things. In general, the opportunity set is better for active management in non-U.S. equity, which is why the majority of our active management is in non-U.S. equity. To a certain extent, we were kind of handcuffing the emerging managers because they were only competing in a very efficient asset class. And the performance also didn't warrant continuing, keeping that that active allocation in that segment.
Neil, in hedge funds, do you have any type of emerging manager program or any type of focus on trying to bring in minority or women-owned firms?
Yes, we do, but we don't do that through a fund of hedge funds, which I know is, excuse me, the way some other pensions do that. We prefer to go direct and have been going direct. So just contact me or Leon Dunklin, and we will we'll take it from there. One thing that I'll maybe add that that will be good news to all the emerging managers out there is that more recently we've probably been telling some firms that they have too much money. And we've certainly been more focused on the smaller and medium-sized firms. So,
Following up, Neil, in that same vein, one of the systems, NYSERS, made a decision to divest from hedge funds. How has that impacted New York City Retirement System's commitment to hedge funds, and how has that impacted what you do in choosing managers and so on?
It hasn't really had too much of an impact on us. We represent 5 pensions. 3 were doing hedge funds. So 2 were already not doing hedge funds. And NYSERS chose to divest from hedge funds, but at the same time, the police pension fund and the fire pension fund decided to increase their allocation to hedge funds. So that's why I say there hasn't really been too much of a change in our office. The police and fire pension funds were able to take some of the capacity in the really, really good funds that are hard closed. So that was very nice. We're almost fully invested now in both the police portfolio and the fire portfolio.
So all very helpful information. Before we go to questions, any additional? So we have a lot of people in the rooms. Many of them existing managers. Many of them wish to be managers in the future. Any tidbit you want to share about, from your lens, how to become involved with New York City?
Well, I think most importantly, it's the process that we do. So that means keep up with our consultants, which are sitting right in the front here. They'll be able to help you out. If it's always good to talk to us as well, because this way we can reflect onto consultants. They have a really tough job because there's so many managers out there that they're trying to screen for us. Keep up to date with their databases. Make sure that all your info is in there. Make sure it's up to date so they can actually adequately review your performance and take a look at your attribution.
Anything on the operational due diligence or investment due diligence that is unusual in what we ask for or might be stressful to them that you can shed some light on?
For public markets, operational due diligence? I guess, to put it in a nice way, we're very needy. We really depend upon the operational aspects of reporting to help us get us through our day. When you actually become a manager, we send out a packet. It's a startup packet, and I think it's pretty long. I haven't read it all, but it's definitely pretty long. But we'll help you with that, and our operations group will help you with that. So we'll run through it together, I guess.
John, from your lens, any advice you can give for those who wish to do business with us and put them at ease somewhat through our somewhat burdensome process to start?
I would just echo what Robert said. Just make sure your data's in the database. If you're here, we're issuing a search. Hopefully, you've regularly updated the databases, so it shouldn't be a big lift to get data in. And then, to the extent you can have the consultants aware of your product and your firm and your philosophy and process, I think that would put you in a good position. And then for emerging managers, contact the fund of funds, and basically they're in a way an extension. We've basically subcontracted out to them, due diligence for emerging managers. So, if you're a small emerging firm, they should be one of your first stops.
Neil, same question?
Yeah. I would say 3 things. Generate really good performance. You're going to find these 3 things funny, but they would be great. Generate really good performance. Give us low fees. And earn your fees because you gave us really good performance and not because you gathered a lot of assets.
With that, let me pause and turn it over to the room for any questions for any of us up here. Yes, sir.
Just curious, John, if you can, with those managers, if you can outline what strategies they're, I don't know,
Sure. One, Legato, is U.S. with a small cap mandate, and the other three are international, Bivium, FIS, and Leading Edge.
Yes, sir.
I don't think we see any great wholesale changes. We're looking at some smart beta alternatively weighted products, which we consider active. But so the results of that search may make some marginal differences. But at the end of the day, it's hard to find $90 billion of active management that you can implement.
And I'll add to that. There's a spirited debate internally on that exact topic, and the data and the performance is very, very supportive of passive management, given the fee structure, and until that changes, it's hard for us for those who support the more active side to have the data to support that thesis.
Hi, my name is Michael from Wonderlust Wealth. I just had a question about derivatives. I haven't heard at all anything about derivatives. I'm just curious, not so much on the fixed income side, more public equity, but do you deal with derivative strategies, yes or no? And maybe that's where sometimes the alpha come in versus the passive. I'm just curious your views.
We don't use derivatives. We've got certain what we call basket clause restrictions based on certain New York State laws, which kind of limits our use of derivatives.
And we allocate 100%, so we have no overlay strategies where we're going to use derivatives to do that. In Neil's managers, heavy use of derivatives in the hedge fund world. So it happens there. Yes, sir.
This is a question for Neil. Do you require commingled hedge funds, or can you do a hedge fund strategy in an SMA?
We're not set up yet to do, SMAs in the hedge fund strategies. We need to set up our back office so that we can do ISDAs and that sort of thing. So yes, we need a commingled vehicle. We usually end up investing in the onshore fund.
Oh, okay. Who asked the question?
Hi. The question I had asked was whether Neil could do hedge fund strategies and SMAs, or whether he needed a commingled fund.
Any other questions for the group on stage? We'll get you a microphone.
Thank you. Amira Strasser from Applied Research Investments. I wanted to ask you how you look at fees for graduating managers and large managers versus emerging managers. Because we talk about the compression in fees, but for emerging managers, obviously they're just fighting to stay alive. And how do you guys see that and consider that across your asset classes?
I would say when it comes to fees, obviously we want them to be as low as possible. But for any active manager, we think we should keep about 75% of the excess return. So, you can have a higher fee structure, but you have to have the returns to justify it.
And I would add, we're cognizant of that difficulty with a small manager, and we're supportive of the program. We want the managers to succeed, and they're not going to get the same pressure from us as some of the more large, well-established managers, as they're well aware, sitting in the room smiling at me.
Hi, Amira. I would say a few things on this. That it was a good question because it actually gives me a chance to explain that on the hedge fund side, we would like to see. We think there is a significant lack of creativity on the hedge fund side, and in terms of fees, and maybe it's the same in all of the asset classes. You'll have to talk to each one of the asset class heads individually, but. People have been complaining in this industry about fees for, I don't know, maybe 2 decades. And there's a lot of smart people in this business. And we're really surprised that people have not been coming up with more creative solutions to lower fees. So some of the things that we're trying to get implemented on the hedge fund side are not just lower fees in general, but one of the ideas is a loyalty program. So the longer you're an investor, the lower your fees are. Maybe they start at 1 in 15, and on your 3-year anniversary, they go to 80 basis points in 12, or something along those lines. We're trying to implement things where if the fund is in a drawdown of, say, 10%, if we give you more money while you're in a drawdown, you give us half off fees. We're trying to do some things where maybe the management fee is lower, but the performance fee is higher. So if you generate really, really good performance, you actually have the opportunity to earn more fees. And maybe your management fee is 50 basis points, but your performance fee is 25 basis points. That also works like a nice pseudo hurdle in replace of a hurdle. So we're trying to think of new and interesting and creative ways like that to get lower fees that are good for us, but also hopefully good for you.
Any other questions? With that, I will turn it back over to Scott Evans, who's going to host a chat with a couple of our managers.
Good. Okay. Nice job. Good job. Good work. Good job. Okay. We are, I'm going to invite 2 gentlemen up here to join me. Ray, why don't you, one of the 3 of us just sit right here, Ray and Keith. This is, you're going to take this? Okay. This is our manager spotlight section. It's a new section. Perhaps I should have mentioned to the folks that are leaving the room that we will be selecting 100% of our managers from the people who remain in this room. So we have cameras, and we'll give you all special badges, and we appreciate you're sticking around for this. So good work. This whole conference is about, and the reason you're here is, how do you do business with New York City? How do you do business with large institutions? There are a lot of emerging managers out there. And we've talked a lot about how important it is for us to find talent. So that all comes together in the presence of the 2 gentlemen sitting next to me in their firms. They were elected by our staff as being the public, in the case of Brown Capital, and private, in the case of Stellex, partners that were emblematic of emerging managers that have been working with the city successfully and that have developed long-term partnerships. All the stuff we're talking about can be seen in the partnership with these 2 gentlemen. Next to me is Ray Whiteman, the managing director of Stellex Capital Management. Stellex is a New York City-based private equity firm. It has been around for several years, but they've just raised Fund 1, and the New York City plans are invested $70 million in Fund 1. Prior to forming Stellex, Ray was a partner at the Carlyle Group and the co-head of the Carlyle Strategic Partners. Next to Ray is Keith Lee. Keith is the president and chief operating officer of Brown Capital Management. He's also, importantly to BAM, the portfolio manager of their small cap growth product. Brown's Baltimore-based public equity manager, been around since 1983. He's got $7 billion under management. $550 million of that is the New York City systems investing in Keith's small cap growth product, which we've been doing since 2009. Keith joined in 1991 to launch this product. They've got a long-term focus strong team that we've worked with for years, and deep knowledge of the healthcare and the technology fields. Very importantly, a track record since inception with our fund of 425 basis points a year above the benchmark, net of what are admittedly pretty high fees.
But it's still 75% higher. I just heard the last panel, correct?
Right. It's high, Keith, but as you know, as a counter-cyclical allocator, this might be Keith's last time on the podium because this success means we'll be giving money to some of you. But in all seriousness, I want these guys to talk a little bit about building their firms. And why don't we start with the question for each of you. We'll start with Ray. Why did you hang out a shingle? What caused you to leave Carlisle, start your own shop? Tell us a little bit and tell the audience about that process and that journey.
You know, I think initially I was told the water wasn't too cold and it wasn't too deep. And I'm from Brooklyn, and there was only one pool, so it was actually a lot deeper and a lot colder than I thought it was going to be. I think in part, when I looked at where I was at from a career perspective, I'd built, the team for 10 years, ran that product for a decade, and had spent 17 years in private equity. I just felt like there was something else I needed to do. And I had come from the banking side, went to Carlisle, and what happened was after, one of these meetings and you walk into a room and there's 45 people that you don't know sitting there, and you're like, okay, so what's next? So that was the first thing that I had to confront as I thought about leaving the firm. Secondly, look, I think one of the reasons I did it was to be up on a stage like this, to be able to have that legacy to talk to a number of other people that are starting firms, what to do, how much is it going to cost, things to think about as they go about doing it. And I think those were kind of some of the key reasons as to why I decided to start Stellex with my partner.
Keith, you guys have been around for longer. Is it different today than it was 15 years ago? What was it like for you and for Eddie starting this firm in Baltimore many years ago today?
Eddie started, first let me thank you, Scott, for having me here today and for being a partner with Brown Capital Management over the last 8 years. It's been extremely important and valuable for us, and we certainly appreciate it. On July 1st, Brown Capital Management will celebrate its 34th anniversary. It was started by Eddie Brown. Those of you who have a little gray hair may remember Eddie from Wall Street Week with Louis Rukeyser, the television show. Eddie came out of T. Rowe Price to start Brown Capital Management for a lot of the same reasons that Ray just articulated. I don't think it's ever easy to start a business, so I don't think it was easy back then, and I certainly don't think it's easy today, and particularly in this industry. As we know, this industry changes constantly, and it's very difficult to do that, but it can also be, when you're successful, very gratifying.
What advice do you have to someone in the audience who's thinking of starting their own firm, thinking of hanging out a shingle, getting into the emerging manager space? What are the do's and don'ts from your perspective, learning from your experiences? Ray, why don't you start?
Yeah, it's a very topical thing, having just gone through that about 4 years ago in leaving Carlisle. I would say some of the key issues that you need to think about is, one, team. The days of being able to just show up with a piece of paper and 5 boxes on it, I think, are long gone. 2 is the underlying working capital to support your business. I think I've had a number of folks that I've talked to about this, and I've said, look, how much are you prepared to invest in your business, and how long can you go without a draw? And that's the reality of starting this business. And if you just say, well, I could go 6 months, then you shouldn't do this. If you say I could go a year, you probably still shouldn't do it. You really have to be prepared to go without a draw for at least 2 years. And you have to fund your team and your real estate and your infrastructure. So it's not a cheap proposition to do this. And I think that's when it hits people that, wow, this is a lot deeper and a lot harder than I initially thought about this process. And the reason I say you have to do that is because the sieve is becoming much tighter. And if you just show up with a one-pager and 5 empty boxes, you're not even going to clear that. You have to be able to bring, the firm has to stand up before you show up and start talking to the consultants, start talking to potential LPs. That's the only way you can even stand a chance in a very crowded field.
Were you able to get funding from Carlyle? Were you able to take performance attribution? Are those two things critically significant to being able to get a start on your own, or not?
No, well, truth of the matter is my partner and I funded the whole operation for close to 3 years. And if you know anything about New York real estate, London real estate is 3 times as expensive. So, and what we did is we lifted a team basically in New York and London at the same time. So the cost of doing that was exorbitant. From an attribution perspective, look, I think that's always kind of a very touchy subject. I would say that I had the support of the founders and the CIO. They were all references for us, and a number of my former partners were references for us. So I think that made it a lot easier. And the fact that some of our numbers were public, and I could show kind of the public numbers, really helped kind of address that issue. And thirdly, the management teams that we worked with. Our strategy is a deep value, special sits, doing some heavy lifting. So a number of managers that we worked with over, for me, 17 years, were references and were able to validate what we were doing and what we had done. So that made it all kind of tie together nicely.
Thanks, Ray. Keith, you operate in a different part of the market, public market space. What advice do you have for people thinking of becoming their own shop?
I think many of the issues Ray just covered, but I would I think focus on 2. One, the more differentiated, I'm going to tell you the obvious, right? The more differentiated your product or service can be, I think on the public side is far more important. It really, it gives you visibility in the marketplace, and the consultants who are the gatekeepers, they will see you differently than they may see your competitors, which I think is always important. The one aspect that in terms of building the business, though, that I wanted to emphasize was the organizational structure. I think that is absolutely key. It's great to have a good idea, a good service, a good track record. Organizational structure is extremely important, and that really does, I think, helps you get into a client like BAM.
You mentioned consultants. Talk a little bit about the challenges of working with consultants, convincing them of your product's differentiation, what role that plays with institutions. What's been your experience?
Huh? No, I'm teasing.
Consultants who are there. I'm told it's a fairly important issue.
What has happened was it's been extremely challenging for us in terms of getting through the consultants. Fortunately for us, when we started 8 years ago, I think we started directly with your staff, which was different than it is now. The issues for me with consultants is that most of the consultants for our clients have inherited us, and few have had direct hires of us. And so when we have gotten on their list, it's because they were looking for an emerging or minority manager specifically, but then it was always difficult to get included as one of on their buy list across the board. Now, in fairness, our small company service has been closed since 2011, but we do have other services. And, you know, that's still, it's an issue, so I'm still trying to figure that one out.
Okay, thanks. Ray, comments about the challenge of dealing with consultants?
I think I need to wipe the blood off my lip here. Look, it's, you know, for a emerging firm, it's going to be tough. The consultants are, by definition, it's much easier to look at a larger player than an emerging firm. You have to do a lot more work to kind of piece together the track record. So there's a lot of hard work that has to be done. I think where we've been successful is really getting to the end LP and then having that discussion with them to help them facilitate and start to push, say, hey, you guys really need to take a look at you know, the underlying firm here. Look, hopefully, look, for me, Fund 1 is now kind of behind, so we'll never be another first fund again to have to go through that underlying issue. And if we perform, you know, obviously it will definitely make it much easier kind of the second time through. But it was, you know, I was counting up the meetings today. With over 450 meetings, we'll end up with 35 LPs. So you have to be accustomed to know. So you have to have a very thick skin going into this particular process.
As you're growing, the client constituency that you have changes. And you go from angel investors or, you know, former employers, friends and family, to foundations and endowments. And then as you grow to be Quaysides, and when you're raising a fund like yours, Ray, you bring on institutional investors like pension funds and insurance companies and so forth. Talk to me a little bit about the different needs of the larger institutions, and how does that change the game that you have to play, the way that you have to structure your firm, or doesn't it?
No, it really does, and I think you have to build the firm for the long haul. And we spent a lot of time really thinking about what we needed, how to put everything in place. I think we spent at least 8 months getting every aspect of the firm. We had all the committees set up, everything done before we even showed up at a potential LP. I think that's the only way you can really address it. I think everyone, some may be faster, some may be slower, but I think they're all going to get to the basic questions, which always goes to track record, team continuity, and you know, how are you sourcing and what differentiates your particular firm? And until you can address that, you need to have everything else in place before you even show up and really go through. Look, we actually did some dry runs with friends of mine who are on the LP side to be able to get their critique of what we were doing. Again, you're only going to get one bite at this apple, and you really do need to present a very polished and coherent and tight presentation with them. And on the other side, as far as working with them, there is no difference between how we work with some of the corporate plans that have invested in us versus some of the public plans that have invested in us.
Thanks, Rick. Keith?
When Eddie started the business 34 years ago, and he was an institutional investor, but starting the business, he took a different approach, and it was basically to build his own independent track record, which was extremely important then as it is now. So he did that in a different way by focusing on smaller plans, and then after that going after the institutional market, hiring another PM so that you had a team, you had the infrastructure that we've talked about. I think in terms of managing the assets, there's no difference. But in terms of expectation with the larger clients, there is a lot of difference there. And you know, if you don't have all of those things in place at the beginning today, I think it's extremely difficult to get any traction to build an institutional firm.
Thanks. Now we get to the point in the interview that's a little dangerous for me. I'm going to ask for constructive criticism from these guys. And they're about BAM and about New York City, and they're in a position to give it. We need them. They're pulling the sled. these two guys are helping to produce the superior returns, and so we're all ears. But tell me about dealing with New York City, the pros and the cons, and with particular emphasis on what we could do better to be more open to managers in general and to emerging managers specifically.
One of the things that's changed, your process has changed since we were hired 8 years ago, but it was an extremely long process. So to the extent that that can be shortened, I think would be, certainly would be an improvement. The benefit of working with BAM, one, you have a brand name as a client, but also, and I don't say this to be ingratiating, your staff on the public side. I mean, it's a very challenging staff. And if you can get through interviews, client meetings with them, you can get through that with just about anybody in this business. And that's a real benefit.
No, I definitely concur with that. Look, I think working with Alex and his staff was very challenging, but but the give and take was, it was a very honest discourse that we had, which is what you need to hear. Alex told us where we were deficient, what we needed to fix those deficiencies with. And yeah, it definitely hurt my feelings a little bit, but we needed to man up and really address some of those fundamental issues that he was pointing to. And we went about and did that. The cycle time on the public plans have their own cycle times. We understand that. That's why you have to build your firm to withstand the cycle time of getting money from a public plan. But with that being said, look, I think my experience was very positive. They told us exactly when things were going to happen, and they hit their milestones as to how they were approaching us. There are other plans where you just go into a vacuum, and you may hear from them 5 months later. You may not hear from them. At least here, you're either going to get a fast no, or you're going to get, okay, here's the process. And if you can stand the length of this process, you could potentially be a manager of ours.
So what I'm hearing from you both in terms of constructive criticism, very delicately delivered, kind of like a fly fisherman, is that our cycle time is off market. It's too slow, and that if we were able to improve our cycle time without sacrificing the rigor of our examination, that would put us more in keeping with other funds. Is that too strong?
Well, I mean, I would say from my perspective, the cycle time was shorter than a lot of the other public plans. It's just in general, public plan cycle times are very long.
We're the fastest of a very slow lot.
Yeah, I was going to say with the cycle time, and again, I know that has changed. I understood it better after the fact, and meaning that again, with John and his team, you really took the time to understand us up front. I think better, and so then down the road, it made some of our meetings a little easier, but it was still long. I don't know how you changed that, but it was still very long.
We're working on it. Notice one thing when these guys talked. They didn't talk about calling the controller. They didn't talk about calling the CIO. They didn't talk about calling the trustees. That's not how you do business with BAM. You work with the teams that were just up here doing the panels. It's Alex Donier and Gabe and David and the folks in PE, Petya and infrastructure, Neil and hedge funds, John and equities, and their teams. That is who's key to doing business with BAM. If you call me, I'll route it to those guys. If you call Scott, he'll route it to me, and I'll route it to those guys. And so while Scott is not involved at all in the decision-making process, nor would it be appropriate for him to be. But for me, I am involved, but only when it comes to the BAM Investment Committee, and I'm only one of the votes there. So this is a bottom-up shop. I don't know that it's always been that way, but it is now. And if you want to do business with us, you got to go through this painful process that they're describing that we'll keep trying to refine. With that, why don't we open it up to questions? Because I know one of the main values of this would be for managers to ask questions of these guys. Yes, ma'am. Why don't you wait for the mic to come to?
Deborah Drawn, Top Capital. Ray, not that we're asking what your number was, but could you give the GPs in the room some guidance as to the amount of money that they need to fund themselves through that first 2 to 3 years of getting their franchise off the ground?
I would say it's definitely 7 figures, and it's probably a couple of 7 figures in there. So, yeah, I mean, when you look at setting up your office, taking on a lease, hiring up a team that's not going to be really investing for a while, and you have to have that all in place before. So essentially, we had 10 people sitting there from kind of March of 2014 until we had our first close of capital in October of 2015.
Other questions for the team?
Deborah Gordon, Opus Capital Management. Keith, did you come in under fund of fund or direct? And when you were allocated the money, how much did you already have under management?
It's a great question. No, we came in direct, and while Scott gave the number where we are today, 8 years ago, we started around 120 million. So I think we're over 500 million today. Assets at the firm would have been, well, 08 is coming off of 07. You know, we always want to forget that. But assets at the firm at that time probably would have been around 1.5 billion, 2 billion max.
Other questions? Okay. Thank you both for joining us today. I think you know, these guys deserve a round of applause for making it through the thicket. And I can tell you, if there are other Brown Capital Managements and Stellexes out there, we want to talk to you right away. With that, we are going to go into our breakout and networking sessions, which I've been told by people are some of the most valued times. We have rooms set up for the different asset classes, which you can see here: public equities, public fixed income, alternative credit, hedge funds, and private equity, up to the 19th floor, real estate, infrastructure, and ETI. Down here, we won't come back together again, so thank you so much for coming to the conference today. Thanks, guys. I really appreciate it. Thank you.